The 15-minute chart feels like the sweet spot, right? Not too fast, not too slow. A stickman trader opens the app, sees clean candles, a few neat little swings, and thinks, okay, I can handle this. That feeling is powerful. It makes the chart look readable, even when the market is still messy underneath. And for beginners, readable often feels the same as reliable. Here's the thing most people don't notice. A lot of courses and trading clips start with the 15-minute chart because it gives you action. Not chaos every second, but enough movement to keep you watching. There's always another setup forming, another candle closing, another perfect entry on the screen. It feels educational. But sometimes it's just keeping your attention glued to the game. Your brain loves patterns that repeat. That's not a trading flaw, that's just being human. When the same kind of candle shape appears over and over, your brain starts saying, I've seen this before. Then confidence shows up wearing sunglasses. The problem is, repetition can trick you into feeling skilled before you actually understand what's happening behind the candles. This is where beginners get burned. More signals can feel like more chances to win, but that's not always true. Sometimes more signals just means more ways to be wrong. A green candle pops up. The bull looks excited, and your finger starts hovering over the button. But frequent movement is not the same as quality movement. Noise can dress up like opportunity very easily. Now, let's talk about the platform itself. Many brokers and trading apps make short time frames easy to access because active traders place more trades. More trades can mean more spreads, more commissions, or more order flow value. That doesn't mean every broker is sitting there like a cartoon villain. But the system definitely benefits when the stickman keeps clicking instead of slowing down. Social media makes this even worse. The 15-minute chart looks amazing in screenshots. A clean breakout, a perfect arrow, a big candle, and suddenly it feels like the chart was obvious the whole time. But nobody posts the 5 failed versions before that one clean picture. A chart can look convincing after the fact, even when trading it live felt like wrestling a candle monster in the dark. And once you spend enough time on this time frame, it starts to feel familiar, almost comfortable. You know how it moves, you know how the candles look, and you start trusting it even when your results say, hey, maybe slow down. That emotional attachment is sneaky. The goal is not to hate the 15-minute chart, it's to stop treating it like it magically knows what happens next. Real talk. Big players are not sitting there hoping a tiny candle pattern saves the day. They care about where orders are stacked. Think of liquidity as the spots where lots of traders have stop losses, entries, and panic buttons waiting. On the 15-minute chart, those spots are often easy to see. So while the stickman is thinking nice setup, the market shark is thinking nice crowd. Most beginners place stop losses around the same obvious areas, right below support, right above resistance, near the clean little swing high or swing low that everybody can see. That creates a cluster of orders, almost like a pile of snacks sitting on the chart. Big traders need liquidity to enter or exit large positions, so those crowded areas become very interesting targets. The 15-minute chart also has just enough noise to make strange moves look normal. Price wiggles, pops, drops, and then snaps back like nothing happened. If you are new, it feels random. But that randomness can hide a bigger process. A candle monster can run through a level, scare everyone, trigger stops, and still look like ordinary volatility to anyone watching too closely. Now add algorithms to the picture. These are not magic money robots. They are systems built to read behavior, speed, volume, and repeated patterns. If retail traders keep reacting the same way on short time frames, that behavior becomes data. The robot analyst does not care about your opinion. It just sees where the crowd usually enters, where the crowd usually exits, and where the crowd usually panics. Because so many retail traders watch this time frame, there can be plenty of activity packed into a small space. That matters because larger players cannot always move in and out quietly if the market is too thin. They need enough orders on the other side. The 15-minute chart gives them a busy little highway of buyers, sellers, stops, and emotional decisions. For them, that traffic can be useful. The short candle length makes traps feel extra fast. A breakout can appear, traders jump in, and within a few minutes the move flips back the other way. The green bull celebrates, the red bear tackles him, and the stickman is left staring at the screen like, wait, what just happened? That speed is the point. It gives late traders very little time to think clearly. But here's the key. The 15-minute chart is not evil. It is just a place where reaction is easy to measure. Big traders can use it to test how the market responds before a larger move develops on higher time frames. If price pushes a level and everyone reacts the same way, that tells a story. The goal is not to fear the chart. The goal is to stop being the most predictable character on it. Imagine the chart starts moving slowly in one direction. Nothing wild yet. Just a clean little push, candle after candle, like the market is politely inviting beginners to join. The stickman trader sees it and thinks, okay, trend is forming. That slow movement is what makes the setup feel safe. But sometimes, that calm walk is just the setup phase before the real move happens. As more traders jump in, they naturally protect their trades in similar places. Long traders place stops under the last swing low. Short traders place stops above the last swing high. It feels logical because those levels are easy to see. But when thousands of people use the same obvious spots, the chart starts building a little pile of liquidity, almost like a glowing target on the screen. Then comes the sharp move. Price suddenly drops into those stops or spikes up into them, and it happens fast. The candle monster shows up with one big scary candle, and everybody who placed stops in the obvious area gets pushed out at once. That wave of triggered orders can actually help fuel the move, because stop losses become market orders when they are hit. Here's the sneaky part. That stop hunt often looks like a breakout while it is happening. Price breaks the level, the candle looks strong, and new traders start chasing because they think, this is it. So now the first group is getting stopped out, and the second group is jumping in late. That extra chasing adds even more energy to the move, right when emotions are running hottest. Once enough liquidity has been collected, the move can suddenly flip. The breakout that looked powerful starts fading. The big candle loses follow-through. Then price snaps the other way, leaving late entries stuck in a very awkward group photo. This is where beginners feel betrayed by the chart, but the chart did not lie. It showed a trap. The problem was reacting before understanding the structure. On the 15-minute chart, this whole story can happen quickly. A slow push, a clean level, a sudden spike, a fake breakout, and a reversal can all play out in just a handful of candles. That speed makes it hard to process in real time. By the time the stickman realizes what happened, the market shark has already grabbed the liquidity and swum away like it paid for lunch. And because this pattern repeats, traders can get caught more than once before they recognize it. They think each loss is a random mistake, but sometimes the same structure is repeating with different candles. This is not about predicting every move. It is about learning to ask better questions, like, where is the crowd trapped? And, has liquidity already been taken, or am I about to become it? The 15-minute chart has a sneaky way of making everything feel urgent. One candle closes, another one opens, and suddenly the stickman trader feels like the bus is leaving without him. That pressure can push you to click before you've checked the bigger picture, your risk, or even your reason for entering. The chart is not yelling at you, but it can definitely make your brain hear a countdown. Fear of missing out gets louder on this time frame because the moves are just fast enough to look important. A candle starts running. The green bull is waving a flag, and your brain says, "Go now, or you'll miss it." But that feeling is not analysis. It is emotion wearing a trading hat. A move can look clean for 2 minutes, then turn around and leave you wondering why you trusted the excitement. Another trap is confusing action with confirmation. When price moves a lot, it feels like something meaningful is happening. Your screen lights up, candles stretch, volume pops, and the whole thing feels alive. But busy does not always mean useful. Sometimes it is just noise with better lighting. The candle monster loves this part, because beginners often treat movement itself as proof that their idea is correct. Then confirmation bias walks in like it owns the place. You remember the one perfect 15-minute breakout that worked because it felt amazing. But the 5 messy fakeouts before it? Those get quietly deleted from your mental highlight reel. That is dangerous because your memory starts building a fake win rate. The chart did not become easier. Your brain just kept the exciting clips and skipped the bloopers. The pace can also trigger revenge trading. One candle stops you out, and before you even breathe, the next candle looks like a chance to get your money back. So the stickman jumps back in, not because the setup improved, but because losing felt bad. That is a rough loop. A trade taken to repair your emotions is not really a trade. It is just frustration clicking buttons with your account attached. The tricky part is that impulsive decisions sometimes get rewarded. You chase a candle, it works once, and your brain says, "See? We're geniuses." That tiny reward can hook you the same way a slot machine keeps people pulling the lever. It does not need to work every time. It only needs to work just enough to make you try again. In trading, that can be expensive education if risk is not controlled. Over time, these little emotional traps wear down discipline. You rush entries, move stops, chase breakouts, and ignore the plan you made when you were calm. And the more predictable your reactions become, the easier they are to exploit. The better move is boring, but powerful. Slow down, label the emotion, and let the setup prove itself. A good trader is not someone who clicks fast. A good trader knows when not to trade. One warning sign is that price gets weirdly calm right before a major level. It creeps towards support or resistance like it is trying not to wake anybody up. The stickman trader sees the slow move and thinks, "Nice and controlled." But sometimes that quiet stretch is where orders are building. It does not guarantee a trap, but it should make you pay attention instead of getting too comfortable. Another clue is when the level looks almost too obvious. If every beginner can draw the same support line, every indicator points at it, and every screenshot on social media has the same arrow, that level is crowded. Crowded levels attract stop losses. So before you treat that line like a wall right away, ask a better question. How many traders are probably hiding their stops just beyond it? Volume can also wave a little red flag. If price suddenly punches into a level with a burst of activity that does not really match the bigger daily move, something may be happening under the hood. The robot analyst would not say, "buy or sell." It would say, "unusual activity detected." That is your reminder to slow down and check whether the move is real demand, real supply, or just a liquidity grab. Be careful when the market sits quietly for a while, then suddenly explodes through a level like it found rocket fuel. That first burst can feel convincing because the candle is big, clean, and dramatic. The candle monster loves a dramatic entrance, but strong momentum right after low volatility can sometimes be the trap itself, especially if the move gives you no clean retest and only invites you to chase. A sharp push just beyond a key level, followed by an instant snapback, is one of the classic signs that liquidity may have been taken. Price pokes above resistance, grabs the buy stops, then falls back under. Or it dips below support, triggers sells, then jumps back up. To a beginner, it feels like betrayal. To a calmer trader, it looks like the market just tested the crowd and found the orders. Also, watch for repeated failed breakouts in the same direction. Price tries to break higher, fails, tries again, fails. Tries one more time, and the stickman keeps thinking, this time for sure, but each failure is information. It may mean the level is being tested, not respected. When a door keeps opening and slamming shut, you do not run through it faster. You step back and ask who is standing behind it. The final warning sign is inside you. If you suddenly feel rushed, excited, nervous, or desperate to enter, pause. That feeling can be useful data. It means the chart is pulling on the exact emotion that causes most bad trades. This is for education only, but one rule is worth repeating. Risk management matters more than being right. If the setup only makes sense when you are panicking, it is probably not clean. Smart traders do not stare at the 15-minute chart asking, is this candle green or red? They ask, where is everybody trapped? That is a different game. The beginner sees a cute support line and hopes it holds. The experienced trader looks around that line and wonders where stop losses are sitting. Same chart, same candles, completely different question. And better questions usually lead to calmer decisions. Before they zoom in, they zoom out. That means checking the 4-hour chart, the daily chart, or whatever higher time frame gives the bigger story. The 15-minute chart is used like a microscope, not a map. It can help with timing, but it should not be the whole reason for the trade. The stickman who only watches the tiny chart may miss the giant red bear standing on the higher time frame. When price breaks a level, experienced traders do not instantly cheer. They watch how price behaves after the break. Was there follow-through or just a sharp wick and a quick reversal? Did the market accept the new area, or did it snap back like a rubber band? Those clues matter. A breakout is not automatically real just because the candle looks dramatic. Sometimes the candle monster is only doing theater. They also care about what is happening underneath the candles. Volume profile and order flow can sound fancy, but the idea is simple. Where did real buying and selling actually show up? A clean candle can look strong, but if the activity behind it is weak or one-sided in a strange way, the story changes. The robot analyst would say, do not just admire the candle, check the traffic behind it. One big difference is patience. Many beginners enter as price runs into a key level. Experienced traders often wait for the sweep first. Let the market poke above resistance or below support. Let it collect the obvious stops. Then they watch for price to return and show whether the move was real or fake. That waiting period feels boring, but boring is often where discipline quietly saves your account. They also treat obvious levels with suspicion. If a support line looks so clean that every trader on the internet can see it, that line may not be protection. It may be bait. The market shark loves crowded areas because crowded areas usually have predictable orders. That does not mean every obvious level fails. It means you should stop treating visibility as safety. Sometimes the safest looking line is the busiest trap. So the real edge is not some secret indicator with a glowing button. It is patience, context, and not reacting like the crowd. Smart money reads the 15-minute chart as one small piece of a bigger puzzle. No setup is perfect, and every trade carries risk. But when you wait for the trap to reveal itself, instead of sprinting into it, you stop feeding the machine and start reading the market with clearer eyes. Start with the bigger picture before you touch the 15-minute chart. Check the 4-hour chart or the daily chart first, because that is where the main story usually shows up. Is price pushing into a major level? Is the bigger trend tired? Is the market stuck in a range? The 15-minute chart should not be the boss. It should be the zoom tool you use after the bigger map makes sense. Next, stop placing your risk exactly where the crowd places it. Beginners love round numbers, clean swing points, and perfect support lines because they look safe. But obvious can also mean crowded. That does not mean hiding your stop randomly far away. It means thinking before you place it. Ask, would every other stickman trader put their stop right here? If the answer is yes, be careful. A stronger habit is waiting for the sweep before entering. Let price poke beyond the level. Let the candle monster scare people. Let the obvious stops get hit first. Then watch what happens next. Does price keep going with strength, or does it snap back like the move was fake? You are not trying to predict every candle. You are trying to avoid being the trader who enters right before the trap closes. Position size matters even more on short time frames. The 15-minute chart can move fast, fake fast, and reverse fast. So taking the same size you would use on a calmer setup can make one messy candle feel like a personal attack. Keep it simple. Smaller size gives your brain more room to think. Risk management is not the boring part of trading. It is the part that keeps you in the game long enough to learn. Track your own trades like a detective, not like a disappointed fan. Look back and ask, where do I keep losing? Maybe it is breakouts near obvious highs. Maybe it is buying after a big green candle. Maybe it is shorting right after a scary red drop. Your history can show you the trap you keep walking into. The robot analyst would not judge you. It would just print the pattern and say, data found. Also, do not rely only on pretty candle shapes. Candles are useful, but they are not the whole story. Volume, order flow, and market context can help you see whether real pressure is supporting the move. You do not need to become a Wall Street wizard overnight. Just understand this: a candle shows what happened to price. Extra data can help explain how much conviction may be behind that move. And finally, accept that sitting out is a strategy. Seriously, not every setup deserves your money. Sometimes the best trade is watching the market shark swim around without feeding it your account. A good trader is not someone who clicks all day. A good trader knows when the chart is messy, when emotions are loud, and when the cleanest move is to do absolutely nothing. Boring? Maybe. Useful? Very. If this video changed how you look at the 15-minute chart, that is the whole point. Not to make you scared of it, not to make you hate trading, just to help you see the game more clearly. The market is not always attacking you personally, even when it feels like it. Sometimes you are just standing where everyone else is standing, with the same stop, the same entry, and the same panic button. So after this, do one simple thing. Open your trade history and look for the pattern. How many times did you chase a candle? How many times did price hit your stop, then move the way you expected? How many times did an obvious level pull you in right before the reversal? This is for education only, but that review can teach you more than another random screenshot on social media. If you want more simple breakdowns like this, hit subscribe and turn on notifications so you do not miss the next Trader Tunes lesson. We will keep breaking down charts without the hype, without the fake promises, and without pretending trading is easy. Drop a comment with the point that hit you the hardest and tell us which time frame you want us to expose next.